Welcome to episode number 44 of The Rent Roll, your podcast on all things rental housing, apartments, single-family rentals, and build to rent. Today's episode is all about the state of the U.S. apartment market, our Q3 update and outlook. I'll be sharing the latest and greatest data, headlined by this surprise. Rent growth is decelerating again. After 2 straight quarters of re-accelerating rent growth, we have seen rent growth backtrack in these last few months, despite seeing some very, very strong apartment demand. And what's also interesting is this slowdown is not just in the high supplied market. So it's not simply about supply alone right now. So I think that's what makes this plot twist all the more interesting. We'll be diving into that today, exploring what is probably not triggering this change in momentum, why it's probably not about demand or affordability, for example. And then we'll talk about what might actually be driving it and where the road goes from here. And then to chime in on this conversation, we'll be bringing in my friend Matt Vance, the head of multifamily research in the Americas for CBRE. We'll get his take on the rent growth slowdown as well. Plus, we'll talk about the overall state of the market, including his latest forecasts on the trajectory of the sector's recovery and rent growth rebound. And also talk about the multifamily capital markets as well. What's going on with all that dry powder we hear about that's earmarked for multifamily. I should also note that most of the apartment and single-family rental REITs are releasing their Q2 earnings either this week or next week. We'll be digging into those earnings calls, transcripts, and presentations and sharing highlights and color starting next week when we'll dive into the single-family REITs and more broadly a little bit on the state of SFR as well. And then in 2 weeks, on August 14th, we'll dive into the apartment REITs and, of course, more color on the multifamily market as well. And fingers crossed, but it looks like we're going to have some very good guests for both of those episodes. So come on back for the next 2 episodes of The Rent Roll. Going to be good. All right, before we dive into the data, I want to give a big shout out to our sponsors. First and foremost, to JPI, a leading apartment developer with the purpose to transform buildings, enhance communities, and improve lives. Again, JPI active across Texas, Southern California, now in Seattle and into the Southeast. And also a shout out to Waymaker, multifamily investment group focused on attainable housing and Class A market rate apartments, partnering with best-in-class apartment builders across Texas and the Southeast. All right, as always, we kick it off with here's a chart, and we got a bunch of charts to go through. And for those of you who can't see these charts, if you're not watching the video, that's okay. I'll walk you through them verbally, learn that lesson the hard way in the early days of this podcast. So let's get right into it. Here's the big story right now. I mentioned earlier, the big plot twist in multifamily. Between September and March, year-over-year effective rent change levels improved every single month, so that's 6 straight months. Then, beginning in April and extending into May and June, rent growth decelerated for 3 straight months. Now, in fairness, we're not talking about some big numbers here. I mean, you may remember, we were at 1.05% in March. We're at 0.49% in June. It's still positive growth, but obviously very slight. So it's not really the number itself, though. It's really the change in momentum that is the story here. And what's even more maybe surprising and interesting than the actual numbers themselves is that this is a trend that's extending to most of the country. If you can see this chart, this is maybe one of the most telling ones of the quarter. It shows by market current rent growth levels versus where they were 3 months ago. Of the nation's 50 largest metro areas, 40 of them saw year-over-year rent growth levels backtrack over these last 3 months. Now, let's talk about some of the outliers first. The big 3 exceptions to the rule and now ranking as the top 3 leading markets for rent growth in the country are San Francisco, Chicago, and New York. Chicago and New York have been top performers for a while now, improved demand, little supply. San Francisco, of course, is at it seems to be at any given point, San Francisco is either the absolute worst market in the country or the absolute best market in the country. It was in the doldrums for quite some time, now finally on the upswing. Now, rents there do remain below where they were prior to the pandemic, even with this 6% increase over the last year. But it is bouncing back thanks to improved quality of life issues, plus some back to the office requirements among the big employers there. Now, on to those markets with decelerating rent change. And again, to be fair, most of these were rather modest, less than 100 bips. For example, if you look at some of the higher supplied markets, some of them still have relatively small backtracking since Q1 and still pretty modest rent cuts. So I'll put in that category markets like Dallas, Nashville, Charlotte, Raleigh, South Florida, and actually a little bit of improved momentum in Atlanta, even if rent change is still negative. Tampa backtracked a little bit since March, but it's still seeing slightly positive rent growth. Outside of the Sunbelt, some modest backtracking in places like Los Angeles, Seattle, Boston, northern New Jersey, Philly, and some Midwest markets like Cincinnati, Indianapolis, Cleveland, and Minneapolis. Now, in most of those spots, rent change is still positive. I believe with probably the exception of just LA, I think, with those markets, and even LA just slightly negative. But again, deceleration since March. A little more material backtracking, deceleration of at least 100 bips since March in Denver, San Antonio, Orlando, Las Vegas, Houston, San Diego, Portland, Riverside, Washington, D.C., Baltimore, Kansas City, Columbus, St. Louis, and Detroit. Among others. I'm leaving out a handful here. But when you look at that group I just listed, there are not a lot of obvious similarities or common themes. Among the non-surprises, we can say that, Denver, that's not maybe too big of a surprise. A ton of supply recently dumped into this market. A lot of its supply for this entire cycle was really concentrated in terms of deliveries in the winter months of this past winter, Q4 and Q1. So that's having an impact for sure. Plus, that market appears to be showing some slowing in the local economy and job market more than we see elsewhere. Washington, D.C., that's what I mentioned. We could point to federal layoffs and weak sentiment in that market right now. I'll touch on that one a little bit more later, and I'm sure it'll come up on the REIT earnings calls as well for the multifamily REITs. The big surprises to me are Riverside, Houston, San Diego, Kansas City, and Columbus. Really nothing, and maybe even Vegas could be in that category too. Really nothing in the data to point to why we would see these rent growth numbers backtrack 100 bips plus. And I've previously, those of you who've been following this podcast for a while, I've previously pointed to Houston and Orlando as two candidates for earlier rebounds among Sunbelt markets. So those two did surprise me a little bit. So what's going on? Why is rent growth backtracking? Well, let's kind of scan the key indicators, the key data points, and see first of all what's not causing this. Let's get some of the big candidates out of the way that we're not seeing real evidence that they're contributing to this rent growth slowdown. And that's going to start with demand. Net absorption, which is how we measure demand in the apartment industry, has actually been quite strong. And again, net absorption, let's be really clear here. This is the net change in number of occupied apartment units. So move-ins minus move-outs. CoStar had Q2 2025 absorption as the fifth best Q2 on record, which goes back to, I believe, 25 plus years. RealPage had it as the best Q2 on record, slightly ahead of 2021. So, we could quibble on data sources, but no matter how you slice it, there's a lot of demand out there, at least on a macro level. We've seen strong demand all across the country, nearly everywhere, in Q2 and in year-to-date 2025. So this is not a demand issue. Now let's talk about affordability. Could affordability be the reason? Well, I think when you look at the data, you could argue affordability was actually more of a headwind in the past than it is now, and it's actually become more of a tailwind again, at least for the market rate, professionally managed apartment sector, as well as SFR. You could say the same thing. Rent income levels have come down back to pre-pandemic levels in the low 20% range. That's thanks to wage growth exceeding rent growth for 31 straight months. That's more than 2.5 years. So again, we have rent income ratios back to where they were prior to the pandemic in the low 20% range. And I'd make the case that improved affordability might be the most under-discussed and underappreciated tailwind, both for multifamily and SFR right now. And again, I'm not getting into the details too much about this, but I want to just remind everybody that when we think about rental affordability, this is a very bifurcated topic where two things are equally true, and yet often we tend to conflate them. Number one, there's a lot of demand for market rate apartments in SFR at today's rent levels, and qualified demand, by the way, at that. People who are actually paying the rent and can afford to pay the rent, spending low 20% share of income toward rent. At the same time, number two here is that there's millions of households who can't afford market rate apartments in SFR, couldn't afford it even prior to the pandemic and the inflationary run up in rents. And for them, there's a severe shortage of quality, affordable housing. So again, two distinct truths. Both are accurate statements, but we need to understand, again, that bifurcated theme. Now, again, as we look at this market rate sector, another supporting data point I'd throw out to show that there's really no evidence of any flight to affordability, or I should say another sign is that there's really no evidence of any flight to affordability, meaning there's no sign that people are moving down into lower priced apartments. In fact, CoStar data shows that the vast majority of the demand that we've seen is going up market to pricier units, the kind of the filtering effect at play I've talked about previously. Most of this new demand is going to newly built apartments or into that upper part of the market. Even with concessions, these are still properties that are at the upper end of the price spectrum. And again, that's where much of this demand is going. So if anything, we've seen more of a flight to quality among market rate renters as opposed to a flight to affordability. Okay, so that's not really the reason we could point to for slowing rent growth. So what about retention rates and occupancy rates? Well, retention's been elevated for quite a long time. They're still high. It's a seasonal metric, but in June, around 55% of expiring leases were renewed. So it's not like we're suddenly seeing a lot more move-outs. Occupancy rates have generally been holding steady, certainly below where they were prior to the supply wave, but still holding steady thanks to strong renewals. So that's probably not a reason for weakening rent growth either. That said, as a side note, I do wonder if we're finally going to level off on retention after continuing to see that number go up and up and up. As my friend Rich likes to say, corn can't grow to the moon. And also as a side note, renewal rent increases have normalized just under 4% nationally, very steadily in that range for a while now. Most markets seeing renewal increases of 3 to 5%. Now, I think it's worth noting that we probably can't sustain that if new lease rent growth doesn't pick up more. It's obviously hard to operate in a gain to lease scenario where you're asking renters in good standing who are renewing their leases to pay more per month than someone coming in is being asked to pay. And so you can grow renewals faster than new leases for a while, but once your actual nominal monthly rent level for the renewal is above the new lease rent, that's a tough situation to be in. Because if I'm a renter, I'm going to the leasing office, or I probably actually go to the leasing office, and that's not something I would do. I would just go and send in an email or a chat message or a text message saying, "Hey, why are you asking me to pay more than someone coming in the front door when I've been paying my rent every month?" So that's a challenging scenario to maintain. So we'll watch that one over these next couple of quarters. But again, nothing here in the renewal data to point to why new lease rent growth is slowing. All right, so what's going on? What is really going on? And I want to highlight a couple of things. And first of all, let me just say that I'll say this. It's like, there's nothing obvious, right? But I do think there's some clues and some ideas I'm going to share with you. So first of all, let's separate the higher supplied markets from lower supplied markets. And I'm going to start with the higher supplied markets here. And when you look at these spots in the Sunbelt and the mountain region where all the supply is going, there certainly is lost rent momentum, but it's rather modest for the most part. And I think that's an important qualifier. Some of that has been driven by an increase in concessions among stabilized apartments that are not in active lease up. In fact, the average concession for non-lease ups in the Sunbelt and mountains is now close to 10%, which is more than 1 month free in that vernacular, more than 5 weeks free. And part of what happened, I think, is this. At least this is my hypothesis. I think a lot of operators got too bullish too quick, and then had to backpedal as they realized it's still a hyper-competitive market. And I say that because I know a lot of operators in the industry, they focus on the fact that peak supply was now in the rearview mirror. As you can see from this chart, supply peaked in the second half of 2024. It's dropped off in 2025. But a couple of things I think we may have lost sight of is, number one, there's still a lot of supply, even if we're past the peak. And number two, while peak supply is in the rearview mirror, peak lease-up competition is not. We're still smack in the middle of peak lease-up competition. We had a record number of new apartments delivered this past winter in second half, especially in Q4 of last year, and another wave in Q1. And we did see good demand, even non-seasonally good demand in that period. But even still, if your peak supply is delivering in what is traditionally a slow leasing period in those cold weather months, that means it's going to push a lot of that initial leasing activity for those new buildings into the spring and summer months, which of course is the stronger leasing season. So that's why I think we're seeing more of that, the continued impact of all those new lease ups in the market taking up much of that demand. At the midpoint of 2025, we have nearly 500,000 units in active lease up. That's double what it was a few years ago, and it's up nearly 100,000 units from this same time last year. So that's a lot. I mean, there's no way around it. We're still smack in the middle of peak lease-up competition, and that's going to have an impact on pricing power for sure. A lot of demand, yes, but again, it's being spread across a very large number of properties, growing number of properties, and most of that net new demand is going into these newly built apartments. So that's why I often hear people say, when I share these demand numbers, I'll be like, "Well, Jay, we just aren't seeing that big demand in our portfolio. We're not seeing that in our markets." And my response is this: I say, I get it, but I also want you to know that demand is there at a macro level. But again, it's spread across a greater number of properties. So you're right to say you may not be feeling the impact on your portfolio, and the data supports that as well. In fact, here's a chart showing the average number of vacant days between leases. In higher supplied markets, which I'm defining as markets with inventory growth of at least 4% over the last year, so at least 4 new apartments for 100 that previously existed, units sat vacant on average 21 days back in Q2 of 2021, right in the height of the craziness. In Q2 2023, 2 years later, it was 26 days. Last year, Q2 2024, it was 28 days. Now, here in 2025 for Q2, it was 29 days. And that's just the average. So some will be meaningfully higher than that. By comparison, if we look at lower supplied markets, which I'll define as inventory growth below 2% over the last year, average vacant days jumped from 21 at the height of the craziness in Q2 21. And then it normalized to 26 by Q2 of 2023. It was 26 again in the second quarter of 24, and it's 26 again in the second quarter of 2025. And that's pretty similar to the pre-COVID average for these markets. So again, you can see a clear difference between lower supplied markets and higher supplied markets, where units are sitting vacant longer between leases in these high supplied markets. And that's a big reason why rents are negative in many of them. It's high competition to capture some of that demand pool that's out there. All right, so then let's talk about these lower supplied markets. These are spots across the Midwest, the Mid-Atlantic, the Northeast, some of the West Coast. And for most of these markets, they're still seeing lost rent momentum, still positive rent change, but lost momentum despite not seeing major supply pressure. So what's going on? I had a few thoughts. Number one, as I mentioned earlier, while they've lost some momentum, these markets, particularly in the Midwest, Northeast, Mid-Atlantic, they're still among the rent growth leaders nationally. And they're still seeing rent growth levels within their normal range for the most part. So that's important context. Second thing, I do think this is still a bigger surprise than the slight backtracking in these higher supplied markets. But when we dig in deeper, as I mentioned earlier, with the higher supplied market as well, most of these markets in the low supply category are also seeing relatively modest backtracking in rent growth levels, and again, still positive. Now, 2 of the exceptions where backtracking is a little more significant, I mentioned this earlier, Baltimore and Washington, D.C. Rent growth there is still positive in those spots, but it's decelerated by more than 150 bips between March and June. Now, of course, we know there's a lot of jitteriness in the greater DC region due to federal layoffs, the impact of DOGE. So that one's not terribly surprising. And by the way, we're still seeing great demand in DC, but it is one spot where we did see turnover pick up. And given sentiment there, it's probably not a big surprise to see some slowing rent growth as operators play defense and prioritize occupancy. And I think DC is really the best example of how weakening sentiment can impact rents. Negative headlines and some mixed signals in the data can naturally, push a nervous operator into a defensive posture to protect occupancy and cash flow. And I think for very good reasons. That's a very rational thing to do. I think there's a similar factor across other markets, even when there's not much supply, and even when the headline narrative around DC and federal layoffs, even where that factor isn't there and might not be as obvious, they're still dealing with that, again, a lot of negative headlines around tariffs and rates and low home purchases, weak consumer sentiment, slowing job growth. I think operators, as a result of all that, they're people. And, we know consumer sentiment is low, and operators are people too. They're consumers as well. And so I think that they're nervous and playing some defense for very understandable reasons. I think others may also not have seen the same seasonal pop that they expected to see in Q2. And I think some of that might be due to the unseasonally strong Q4 and Q1 that we saw in many of those markets. And maybe some of that demand that we typically would have seen in Q2 actually shifted up earlier in the year. And I would again point out that, as I've said previously, that we just, in the post-COVID era, we just haven't seen the same normal seasonal patterns as we saw prior to COVID. So maybe that's a factor. Again, it's too early to say when you get a conclusion. I don't want to be one of those guys that comes across saying things with strong conviction that this is what's happening and why. But I think that might be a big part of the story. And on that point, I just add this. I've said this previously. Operator sentiment is arguably the most critical variable that cannot be easily modeled or tracked, and yet still plays a huge role. And so, again, we'll see how this plays out. Again, I don't want to downplay the fact that there obviously are mixed signals in the macroeconomic environment right now, a lot of uncertainty. And so it could be that we're seeing some early signs of cracking in the economy. We can't entirely dismiss that. But my guess is that we're seeing more of a blip in the data right now, and I think that it could be part of kind of a 2 steps forward, 1 step back recovery that we're seeing. But I say that because I still tend to think that tailwinds outnumber the headwinds, especially seeing the demand numbers that we're seeing the improved affordability. And so, my best guess is that we'll see the rent growth rebound return before too long. But again, we'll get Matt's take on that as well in a bit when we move into the interview portion. Now, of course, one of those tailwinds that's coming up is going to be supply, future supply. Supply is a big headwind today, but quickly trending toward a tailwind for the future. Starts are down from peak levels by more than 50% in much of the country. Total apartment starts at the lowest levels in more than 10 years. Still a big chunk of construction projects to work through, but much of that's going to complete here in 2025. By next year, we'll almost certainly see a lot less supply. And I think that number is going to come in around 300,000 units, give or take, which would take us back to mid-2010s levels. And supply will probably dip even further in 2027. And remember, of course, forecasting is an inexact science. Supply is the easiest variable to forecast, though. It just starts being pushed forward. Not a lot of starts right now. And so with supply being the biggest current headwind and that headwind subsiding, even if the macro environment, slows a little bit, as long as it remains somewhat steady, and as long as we're, in seeing some growth, we can see demand normalize somewhat off today's huge totals, come down a little bit to more normal, sustainable levels. And you can still easily see a scenario where we get that long-awaited rent growth rebound, and seeing that plays out. But again, I want to get Matt's take on this as well. So stay with us when we bring in Matt Vance, and you'll hear his take on the same topic. All right, last thing before we move on, real quickly on sales and capital markets. Apartment sales volumes are crawling upward at a snail's pace, nearly 140 billion in apartment sales nationally over the last 12 months, according to MSCI Real Capital Analytics. Cap rates have kind of leveled off around 5.4% nationally, but of course, we're seeing deals trade in the fours, especially for well-located, newer vintage assets. And we'll talk more with Matt about this later as well. And of course, he has a good vantage point working for a major brokerage group at CBRE. But I suspect we'll see more of the same. My personal opinion is I suspect we'll see more of the same in terms of volumes and cap rates until we see clear evidence of a rent growth rebound taking place. Obviously, rate cuts will be helpful too, but I don't think the market is expecting much of that. And you can argue that future rate cuts may already be priced into some of today's deals. We talked about this last week with Zach Boyer, the head of living sector valuation at Cushman & Wakefield. But he made a good point, which is that, look, everybody loves multifamily. Everyone is generally buying into the same story, that same outlook of strong tailwinds for future growth. And that means as much as buyers like multifamily, sellers do too. So unless they're in a position to have to sell, most would-be sellers are choosing to wait out better days. And so you got a lot of capital that's raised, a lot of groups have raised capital to chase distressed deals deeply discounted, but those deals really haven't materialized in any scale and for a variety of reasons. But really headlined by the fact that owners and their lenders are still optimistic on the outlook, and so they're willing to wait it out. It's not like in the office sector where you have sellers who just want to get out and opportunistic buyers who are capitalizing. But again, we'll talk to Matt about that as well. All right, next up, rental housing trivia. All right, rental housing trivia is presented by Foxen, a technology-first renters insurance and compliance and rent reporting platform that helps you reduce risk and drive NOI. I should say renters insurance compliance and rent reporting platform, excuse me. Check them out at foxen.com. That's Foxen.com. So today's question is, over the last 20 years, this market has had the lowest rent floor in the country, meaning it's never cut apartment rents more than 1.2% year over year. That's for new lease effective asking rents on a same store basis. So which MSA is it? It'll be 5 choices. A, Baltimore. Is it B, Chicago? C, Kansas City? D, Minneapolis? Or E, San Diego? So which one has had the highest floor over the last 20 years? And I think I misread it earlier, not the lowest floor, it'd be the highest floor, having not cut rents more than 1.2%. So give that some thought and we'll answer that in a bit. Next up, in the news. All right, we've got a few big articles this week on the single-family rental market, and so I'll cover those, and we'll touch on a few that relate to multifamily as well. The first one comes from CNBC. It says, institutional landlords see new competition from an unexpected source. And this is a good read from Diana Olick, and it really hits the nail on the head for SFR right now. I'll read part of this. It says, some frustrated sellers are deciding to delist their properties and instead offer them on the rental market. These new rentals are coming in direct competition with institutional investors in the rental space, especially in markets where those investors are most prevalent. All right, so these are what we call accidental landlords. Individuals unable to sell their homes for whatever reason, maybe just can't get the price they want or can't find buyers, and they end up putting their homes on the rental market and maybe waiting out a better selling environment. So for whatever reason, they have to move. They're finding another place to live when they're putting their other home on the rental market. And I suspect we'll probably talk more about this in next week's episode, specific to SFR REITs and then the quarterly update for SFR REITs. But I do think it's a factor in why new lease rent growth has been soft for SFR of late, despite the strong demand tailwinds with fewer people buying homes. Because remember, it's all about supply and demand, obviously. So the influx of rental listings via accidental landlords has the same impact on the SFR market as new apartment supply has on the apartment sector. And so that, puts downward pressure on rents. So a good read from CNBC. The next one comes from Boston.com and the Boston Globe. It says, Boston single-family rents shot up more than any other major city, new report says. Well, I saw this and I posted about this on social media, and my comment was, this seems kind of weird. Institutional investors comprise less than 2% of Boston's single-family market, according to data from John Burns Research and Consulting, and yet Boston led the nation in SFR rent growth. Well, that certainly doesn't align with the conspiracy theory. So maybe it is all about supply and demand, huh? So, by the way, for added context, the John Burns data shows the top rent growth markets for SFR right now are basically all, non-institutional markets, or markets where large institutions have very, very little presence. And so some people might ask, hey, why is that? Why aren't the SFR REITs and institutions chasing these higher rent growth markets like Boston? And the reason is actually quite simple. It's because it's not about rents and rent growth alone. Boston is an expensive, low inventory market. It's very difficult to build operational scale needed to be investable for bigger players. They need operational scale to be efficient. So more rent growth isn't necessarily helpful if your expenses are meaningfully higher and growing faster too. So that's why. All right, next one comes from the Wall Street Journal. It says, with individual homebuyers on the sidelines, investors swoop into the market. High interest rates and prices aren't deterring firms from snapping up single-family properties. All right, so I believe it or not, I really don't enjoy poking holes in these media articles, but this is another incredibly misleading story that's lacking basic critical context. Are investors really swooping in to buy single-family homes because individuals are sidelined? And the answer is not really. In fact, if you look at the most recent data on investor purchases of single-family homes, using data from John Burns, that total number over the last 12 months is lower than at any point since 2013. And so investor acquisitions are down, not up. But this article says they're swooping in. Investors are swooping in. And that implies an increase in investor purchases. Investors are not swooping in. They're impacted by high rates and sticky prices too. Okay? But this article is based on data showing the share of all single-family home sales coming from investors. So that's a big critical difference. The percent of sales versus the absolute number of sales. The percent of sales represented by investors are up. The total number of investor purchases are down. But the article does not mention that the total number of sales driven by investors or coming from investors is down. And again, that's super critical context, because without it, the boogeyman conspiracy theorists can use that as fuel for their conspiracy theories and bad policy ideas. Now, that said, I do want to give the Wall Street Journal some credit, because they did note that all these investor purchases are being driven by smaller investors, not by large institutional investors. And of course, we know it's always been the case. So it's helpful to include that context here. So I do want to give credit where credit is due. Kudos to the Wall Street Journal for pointing that out. All right, next headline comes from NPR. NPR's Morning Edition. It says, frustrated by NIMBY, states are trying to force cities to build affordable housing. And I'll read a little bit from this. It says, a key problem pushing up prices is a massive housing shortage. In large parts of many cities, restrictive zoning rules allow only single-family homes. And some places have updated their zoning to allow duplexes and apartments. Trying to change the rules is often controversial, time-consuming, and costly. It can also be blocked outright by local opponents, often called NIMBYs. Frustrated by this, a growing number of states, both red and blue, have started pushing local governments to build more places people can afford and passing laws that make it easier. All right, so good story. And NPR highlights policy wins in Utah and in Texas. Of course, we've also seen this recently in California as well. Good wins for housing production in red and blue states alike. Good to see NPR highlighting that. Next headline comes from the LAist, and the headline is, roasting in your apartment? LA County could soon require landlords to keep rental units cool. All right. Well, hey, listen, I'm all for apartments staying cool in the summer, but Los Angeles is a market that's uniquely skilled at driving up the cost to build and operate apartments while simultaneously driving down potential revenue generated from the apartments. So it's tough to invest capital into your buildings, even for necessary expenses, when you can't afford it or can't get a return on it. And so I think, again, I'm all for ideas like this, but you have to make them viable. All right. Let's return to today's rental housing trivia question. And again, the question was, in the last 20 years, this market has had the highest rent floor of any market in the country, never cutting rents more than 1.2% year over year. Which MSA is it? And I'll give you 5 choices: Baltimore, Chicago, Kansas City, Minneapolis, and San Diego. The correct answer is A, Baltimore. All of these have been relatively low volatility markets over the past couple of decades, but the least volatile is Baltimore. Never a big ceiling market either, but again, high floor, no rent cut in the last 20 years of more than 1.2%. All right, so let's jump into today's interview. We've got with us Matt Vance, the America's head of multifamily research at CBRE. We'll dive into the current state of the multifamily market and get his take on where things go from here. I'll also ask him the hard questions around why rent growth is slowing and get his take on that topic I've spent a lot of time on earlier. So please welcome in Matt. All right, now welcome to the interview portion of today's podcast, and I am honored to welcome in my friend of many years, the head of multifamily research at a little company called CBRE, Mr. Matt Vance. So Matt, thank you so much for being here today.
Yeah, thanks, Jay.
Before we jump into all the heavy stuff, tell us a little about your story. How did you end up in the beautiful career that is multifamily research?
I don't know if it's common. It seems common. I wound up in this business kind of just by happenstance. I was leaving a PhD program in Boulder and cast a pretty wide net for jobs, and I wound up working with a local legend, Marcel Arsenault, who founded Real Capital Solutions, sort of a highly active capital investment management shop based just outside of Boulder. So I cut my teeth there, and he taught me what I needed to know to land the big gig with CBRE. So I joined our econometric advisors team. He and I had been doing a lot with multifamily, and so that's where I made my entrance with CB, forecasting multifamily fundamentals.
All right, now heading up research for multifamily, and it's still based in Denver area, right?
Oh, I've been all over the place, Jay, doing market research. I've lived in Chicago and Nashville and Denver, Boulder, Spokane. A little bit of time in DC and New York, but I'm back in Denver and I'm loving it.
Nice. Yeah, you've covered the territory for sure. So, Matt, one of the things I shared earlier in the podcast is that, in my view, the big story right now is we have really strong demand, but no rent growth. And I want to just run really quickly my theory by you. I think there's a lot of nervousness among operators right now. We have a lot of stabilized properties that maybe didn't see the same surge of leasing they're used to in the spring, summer leasing season. You have lease ups getting a lot of that demand right now. High retention, that's keeping some would-be movers off the market. But feel free to disagree. What do you think? What do you think is the big story right now?
Well, I agree that there is some nervousness or protecting their existing occupancies with some favorable renewal rates, especially in the Sunbelt, where there's a lot of competition of that new product that you mentioned. But listen, I mean, our stats don't necessarily agree with what you just said. I mean, we're going to be, issuing our second quarter figures report here in a few days, and we showed a pretty significant drop in vacancy or a bump in occupancy for stabilized properties, really across the entire country.
Good.
And nationally, our stat is now 4.1% vacant. That compares to a 5% equilibrium. We are well below, and we should expect in a normal market to see pretty strong rent growth based on that occupancy. We're not seeing it, as you said, and I do think that has a lot to do with the properties that have completed, that are still in lease up and have not yet hit the stabilized statistics that all of the third parties report on. And so, we just released a report a month ago tomorrow on this pre-stabilized market and the impact it's having on the stabilized overall market, and it's pretty significant. And I think you're right that you've got a lot of competition among these coming from these new properties, and landlords are doing what they can to preserve and shore up the occupancies they have. And I keep saying, we're getting this record absorption at the cost of rent growth, right? That's how suppliers compete, is on price, and they're competing for this for the existing demand, and they're competing for new renter household formation.
Absolutely. So
and it's working.
Yeah, no, absolutely. Again, it's not a demand problem for sure. So let me ask you this follow up then. What really I think is more surprising is, given that demand, you'd expect to see some more rent growth momentum. We had that coming into the spring, but then it disappeared. Even in these lower supplied markets in the Midwest, the Northeast, and even SoCal, which lost the little momentum it did have. So when you look at, and let's just start with the lower supplied markets first. When you look at those numbers, I mean, first of all, do you agree? And if so, what do you make of it? Is it just a blip?
Well, I mean, we're still showing healthy rent growth across the Midwest and in the Northeast, right? I agree. Momentum is a tricky word, right? It's really the second derivative. It's accelerating rent growth, and we're talking about growth in the first place. So, yes, I agree. We lost some momentum. We lost that second derivative. But look, these are markets that are still performing healthy, and I think, well, I'm a firm believer in mean reversion, right? And I think that 4, 5, 6% rent growth in some instances isn't sustainable. And I think they're going to bounce around between what's healthy and what's maybe a little bit unsustainable here for a little while longer. So yeah, I guess to answer your question, in those lower supply markets, I do think it's a little bit of a blip. I think it's just a little bit of a bouncing around the mean, and it's going to oscillate like that for a little while.
Yeah, I tend to agree. I mean, look at markets like Kansas City that lost a good bit of momentum. Still a top 10 market, but that lost momentum, it does look more like a blip because there's nothing in the underlying data to suggest that it's warranted. Let's switch.
Jay, I don't see the tours data, right, of potential tenants. It could very well be that demand has maybe slowed down a little bit going into this season for some reason, and they're getting less foot traffic for those final few units that they're trying to lease. And so they're backing off a little bit on pushing rents to try to get that back. But, I don't see behind those curtains all that often. And so it's hard for me to answer exactly why that's happening, but I would not be surprised if it's just normal sort of almost micro cyclicality throughout the year.
Yeah, I think that's a good point. I actually agree with that. I think anecdotally, there's so much nervousness around everything right now that if there's a little bit of drop off in traffic, it puts everybody in this defensive posture. We got to pull back a little bit. So, but again, the underlying fundamentals seem healthy. But let's talk about the Sunbelt mountains, the higher supplied markets. Y'all at CBRE, you've been pretty bullish on the rent rebound for this year, and candidly, I have as well. I've even shared your the forecast y'all have put out. Do you think that's are those forecasts? Do you still think that's the case, or are you revising those down much?
Let me first say I wouldn't characterize it as bullish. All right, our outlook for those, particularly the top 15 high supply markets, was that they would achieve some level of positive rent growth this year.
That's fair. Yep.
Okay, that's what our outlook was going into the year. We actually still do believe that, with a few exceptions. All right, and so when April 2nd happened, and we had to kind of reevaluate our macro expectations. All right, it did push things out slightly, a couple of quarters here, maybe a few quarters in some other markets, and so I've put up charts in many of my presentations that compare forecasts across, maybe the primary third-party forecasting shops, RealPage, Yardi, Matrix, and CBRE econometric advisors. And really what I show is we're all really relatively aligned in the long term, even the medium term to some extent. Where we differ is in the very near term. Right, Yardi, I think, feels like this supply wave is going to take longer to work its way out or through the system for those concessions to burn off, and so their recovery is slower, even though we end up at the same place. And RealPage has been at least fairly consistent with more of a snapback. All right, where we're seeing positive rent growth coming back earlier than what CBRE has been saying. But all very similar in the medium and the long term. We have downgraded our outlook slightly, right? And I say that because we downgraded our macroeconomic expectations. All right, and so really there's two drivers primary drivers in the model. The number one and the most immediate concern is, or not concern, but what the model takes into consideration is momentum. And we've already talked about that. And there is momentum. Occupancies continue to improve. In many cases, rent growth is still negative, but it's less negative. And things are trending the direction we want. Okay. We think that's going to continue. The macro, and particularly employment, then drives much more of the longer term outlook. And so when we reevaluated things, we saw a few markets in particular: Austin, Texas, Denver, and Salt Lake City. I think Jacksonville as well. I think it's those four markets that now we don't expect positive rent growth until the first half of next year. All right. So that was a 2 to 3 quarter delay in their recovery. That's just to get positive. Right. And so, again, I wouldn't characterize that as bullish. But I will say, if you stack it up against a few other forecasts, it's certainly not the most pessimistic. It's a pretty healthy recovery outlook.
That's fair. And bullish is certainly the wrong term. I think anything positive is almost considered bullish these days, right? Just because you're right. Getting out of that. And I want to make a quick point just for the research nerds listening. It's like, I think one important distinction is you look at the Yardi data versus CoStar, RealPage, CBRE, Green Street, Witten. Yardi has fewer completions in the past, a lot fewer, and a lot more in the future. And I don't know why that is. I'm assuming it's a methodology difference, but I think that does influence some of their forecasts. Matt, you had mentioned some markets that you think will take longer to recover: Denver, Austin, Jacksonville. What was the other one?
Salt Lake City.
What markets do you have recovering the fastest among these higher supplied ones?
Boy, that's a good question. They're all really clumped together, and so. Yeah, we've got some. I don't know, Jay. I have to.
Would it be like Carolinas, Dallas, Tampa?
Charlotte's in there. There's Miami is technically a high supply market that we have performing pretty well. Phoenix is in the middle of the pack. Dallas, Atlanta, all in the middle of the pack. I think Atlanta's a little bit quicker than those two because they really are past their supply peak, right? And it really felt more like a supply peak than maybe somewhat of a plateau in Dallas, right? Where it's just kind of lingering.
Yeah, and Phoenix, I think, will be one where it's like east side versus west side. It'll be a very different story. Yeah. What about long-term outlook for the Sunbelt? So I've talked about this previous in this podcast, but you look, prior to these last couple of years, the Sunbelt, even with more supply in the rest of the country, really wasn't that supplied relative to demand. And so we tended to see higher rent growth. Do you think we revert back to that as supply peters out?
I do. Yep. We're just now running our preliminary second quarter forecasts based on the second quarter, data. And I think it's going to look very consistent with what we had put out just a quarter ago, which, if you look at markets like Phoenix, right, and some of those major employment and economic engines of the country, and Dallas, Phoenix is, if you limit the sample of markets to just 100,000 units and above, right? So the larger units, the more institutional type of markets. Phoenix is a top 10 market for rent growth on a 10-year CAGR. It doesn't rank that high. It doesn't rank as high on a 5-year because of that near-term, negative rent growth in the next, call it few quarters. But yeah, it's a top 10 market, and the same is true for many of those Sunbelt markets.
Yeah. And I think you're right, too. I think people, for all the talk around the supply, people tend to understate the demand side of the Sun Belt, particularly the Wall Street folks always talk about supply, not about demand. So our friends tracking the REITs, not all of them, but some of them. Matt, let's switch to another topic. Let's go to some demand side issues. Speaking of demand, I've tried to make the case that affordability is one of the most under-discussed stories in multifamily and SFR, and specifically affordability reemerging as a tailwind, especially for the Class A and B market. You could argue Class C is different. But we have wage growth outpacing rent growth for 2.5 years. But what do you think? And of course, feel free to tell me I'm wrong.
Sure. Yeah. Well, let's start at the most expensive markets, right? The markets where your average rent to income ratio is north of 30%, even in some of the higher quality product. markets like San Diego, markets like New York, right? And when you look at those markets, it's always been true that those markets have carried a higher rent to income ratio, and it's because they offer elements of quality of life. Maybe it's public transit and vibrancy and just other offerings that other markets don't, that people are willing to pay for, right? And it's a price, and so folks are willing to pay that higher price to be in Southern California. I would agree that there is some elements of a tailwind here from greater wage growth than rent growth. I actually, on the affordability side, we've been digging into some census data using some newly available algorithms that really allow us to eliminate folks with zero income.
Yes.
All right.
Yes.
And to focus on just only renters of multifamily. We can even look at renters of just 50 plus unit structures. And I think you're absolutely right, especially in those higher class and higher quality assets. And we hear it from our clients that there's very little concern about the affordability of these institutional grade units from the tenants that they're getting, or applicants, I should really say. And but one other thing, I want to tie this back to supply. All right, because when we think about affordability and all of the talk around regulation and the concerns around the unaffordability of the U.S. housing market, I want to use Austin, Texas as an example. All right. Austin was one of the leading markets for rent growth in 2021, early 2022. And all of that surge in demand was just fueling very high occupancies, very strong rent growth. In fact, at one point, rents were 25% higher than they were before COVID.
Mm-hmm.
All right. In a very short period of time, call it 2 years. Today, in Q2, those market average rents in Austin, Texas are 6.5% higher than they were at the end of 2019.
Yeah.
That is not even close to inflation, right?
Yeah.
And even less than wage growth. If you think about who's moving there,
way less. Yeah.
Jobs, it's way less. So affordability has pretty dramatically improved across Austin because of the ability of developers to permit and build large numbers of housing units.
You said it. Yes, supply is the solution to affordability. Absolutely. And Matt, you said something else. You kind of just said this casually, but it's actually a really big deal. It's like when you look at that census data that gets used a lot by the Harvard Joint Center for Housing Studies, my policymakers, that data is skewed by hundreds of, I think almost 1 million households that have either zero or somehow negative incomes, which I still don't know what negative income means, or very, very little income, less than $10,000 a year. And so you're right. When you weed that stuff out, you look at just multifamily, you get to rent income ratios that more match what we see in the institutional sector, which is low to mid 20% range. So I think that's a good story.
It is. It really is.
Let me ask you about another hot button topic right now, and that is the big, beautiful bill. You mentioned kind of you've done some work lately on your kind of macro picture, how that impacts rent growth. But I'm curious, how in your view is that going to impact household formation, economic expansion, and ultimately apartment demand?
Sure. I will be honest, and I leave some of the macro to the macro economists at CBRE.
Hey, me too. Yeah.
I think that, in looking at the bill, look, I don't think that this bill is going to dramatically expand the budgetary constraint on today's multifamily renters. I just don't. All right. But what I do think it will, I do think it will serve as some level of stimulus to the economy. All right. And I think that and look, if you look at the last few months of economic data, the jobs numbers, if you look at the continuing claims, right, unemployment, all of it is really quite healthy, right? And if you, and yet sentiment is relatively low. If you layer on some economic stimulus from a largely tax focused big beautiful bill, I do think we're going to see that pump the economy a little bit, and I do think there's some upside there. And I do think that will ultimately, even if it doesn't directly impact the budgets of today's renters across most markets, I think that it will improve sentiment. And we know that sentiment is wildly important to household formation and apartment demand. So I do think that there is some upside to the demand side that could come from that.
Yeah, good point. Another hot button topic while we're going through these on the demand side, buy versus rent. And I know we've had some healthy disagreements, so I want to feed into that here. I'm of the view, as you know, that I think ultimately we need to see more home sales to stimulate more economic growth. That'll result in more household formation. We'll lose more renters to home purchase, but we'll backfill those units faster at a higher rent. What do you think?
I think as an intellectual exercise, what you just said is totally plausible. All right. That home sales will spur. What do you do when you buy a house, right? You paint it.
Yep.
You make it yours, right?
You go to Home Depot and all that.
Yeah. And so sure. That could stimulate the economy. That could stimulate confidence on the consumer side and drive household formation and could more than backfill any renters that we lose to homeownership. Sure. Will it happen? I don't buy it. I don't think so. Right. And I think it has a lot to do with what I really firmly believe is a housing shortage in the markets where most people want to live. All right. So you don't see a housing shortage in a lot of the country. In fact, I think I just saw a really great map from John Burns Consulting. But anyway, this housing shortage, it's a very different situation today than it was coming out of the global financial crisis, right? Where we overbuilt homes, right? I was painting houses, by the way, Jay, back in 2006 and 2007 in a previous life, new construction homes in Michigan. And Michigan had built so many what we call spec homes, right? Homes that didn't have a buyer yet, that if we didn't build another home for 10 years, we would have enough for the demand that economists were projecting.
Yeah.
All right. And this time is very different. Now we're supply constrained on the single family side, right? Which is helping prop up home values. We have a limited for sale activity market, right? Where folks are locked in at very low interest rates. We're starting to see some of that move, right? We're starting to see prices come down in certain markets that may be overheated relative to other markets. But still, even as prices in Denver have come down 11%, right? Or in Salt Lake or in South Florida, even to a greater extent. The premium to buy versus rent at today's mortgage rates is keeping renters renting for longer. All right. And that I think is really important.
I agree with you.
Because you said we'll lose some people to homeownership. And today we're not, right? They're staying put because they can't buy. We were just working on a deal in San Diego, and we just wanted to know, using that same micro census data, what we found was that of renter households in San Diego, 4.2% of them could possibly afford the median home in San Diego today. And that's assuming no other debt, right? And a 40% debt to income ratio and a 9% down payment, which is the average according to the NAR. And, we layer in maintenance and insurance and taxes and PMI for that 9% and today's prevailing interest rate. And it's just so difficult to leave. So I guess my challenge to you is, from your thought experiment, yeah, sure, I could see that. But are prices going to come down enough to shrink that premium of the buy versus the rent cost? And let me give you an anecdote. I just moved back to Denver. Now, I don't think I was ready to decide which neighborhood I want to buy a home in. So I rented in Cherry Creek, where I've lived for years before. Right now, I'm paying rent on a maintenance-free agreement, right? With no real significant risk from taxes or insurance changes other than my renewal rate in a year, right? So right now, my rent is equivalent to, I did the math, not for this. I did this for my own sanity, because my rent today is about 60% of what it would cost me just in interest, taxes, and insurance on a comparable condo or single family home in a desirable neighborhood.
Yeah.
It doesn't make sense for me. I would have to live in that home for probably a decade or more for the math to actually work. And it does work, right? It on a long enough horizon, it can work to buy a home even today. So I don't want to say it would never make sense to buy a home. It just doesn't for me.
Yeah. No,
and we started this podcast. I've lived in 8 cities in 10 years, 11 years. Where am I going to be next year? I don't know. So
Yeah. No, yeah. You want to be, if you're not planning to be in the same spot a long time, then yeah, you're right. It doesn't make sense. And oh, by the way, I think all of your points are very good. My only thing I would point back is that yes, people are renting for longer. I think some of them will eventually age up into SFR, but they're in apartments longer. My concern is that renewals are just obviously one piece of the pie. And historically, we see more rent growth and NOI growth when we have a healthy for sale housing market. It doesn't have to be crazy hot, but I think it has to be healthier to stimulate more overall growth, the new lease demand side and the rent growth to get the market kicking in again.
I'm going to say the scariest 4 words, Jay.
Uh-oh.
Maybe I'll say 5 words.
Okay.
I'll put the word could in. This time could be different.
Oh, okay, yeah. I don't think economists are allowed to say that.
I don't think so either.
No, I'm genuinely. You make very good points. So we'll see how this plays out. So let's switch to capital markets. Sales volumes. They're kind of ticking up at a kind of a crawling up, slow pace, snail's pace. We know everybody, investors, I mean, every survey of every type, international investors, domestic investors, institutional, private equity, everybody loves multifamily. It's a preferred asset class for the long term. Yeah, there's dry powder. We always hear about the dry powder. And we all know the reason. We don't need to rehash the reasons. I think everybody knows why. But what are would-be buyers telling you right now? What are they wanting to see to actually deploy more of that dry powder we always hear about?
All right, well, let me say first that yes, the headline stats is a crawl in the recovery in transactional activity, right? I think if you compare first half this year, first half last year, it's up a couple of percent.
Yeah.
If you take out Air Communities, that entity level portfolio, right, we're up 22%.
Oh, that's a good point. Yeah.
Okay, so just for the listeners, like look, my favorite quote in all of economics came from a famous economist, Ronald Coase, and he once said, "If you torture the data long enough, it will confess." Okay, so if you want to say that the market's flat, you look at the headline stats. If you want to say the market's up and you want to feel good, you take out Air Communities and you say, "Hey, we're up over 20%."
There you go.
So
yeah,
I think it's a more relevant stat because that really was a one-off, massive acquisition that skewed the first half of last year. But to your real question, what are buyers really looking for to get that capital deployed? Look, they're looking for stability and they're looking for yield as a very pervasive theme, right? And when you look at markets where there's not a lot of yield, cap rates are tight and fundamentals are taking longer than we want and longer than expected to recover. There's not a lot of activity outside of the best product. All right. But when you look at some of the Pacific Northwest is getting a lot of attention. Portland, you're in Seattle, you're getting it across the Midwest, a lot of attention because not only do many of those markets, I should say, have higher average yields or cap rates, they also, as we've already said, have these fundamentals that are stable, right, and healthy. Rent growth, occupancies, and NOI performance. So, I think we're seeing a little bit of a shift into some of those more stable, higher yielding markets and product types. But ultimately, they want some more stability, right? They want more evidence that things are going the right direction. I read your post this morning on LinkedIn. I think it was today, talking about this. Really, it's the bid-ask spread, right? And buyers wanting to take advantage of the slow fundamentals today and benefit on the upside, and sellers wanting those same buyers to price it in and meet me up here, right? And so I think they will meet probably, honestly, closer to the seller's expectations.
Yeah,
because they'll just wait long enough for that to work. But we're getting there. All right. I just looked at I looked at our national vacancy, right? Back to your earlier point about the different data sources on how vacancy or how occupancy is being reported and how it's changing. Look, if you zoom out, all right, we saw occupancy falling for, I think, 8 consecutive quarters, all right, and then for the past 5 quarters, it's been improving. And it improved more in the second quarter, according to our stats, than any other second quarter on record. right? In fact, absorption in the second quarter that we report, because it's derived from change in occupancy and the number of occupied units, was the strongest second quarter absorption on record.
Yeah.
Even stronger than 2021. So, I think we're getting there. And I think that's what buyers and sellers really are looking for. And, because the debt markets are incredibly liquid, right? And highly competitive. There's a tremendous amount of capital that wants to be placed. All right. There's actually, we go to NMHC together every year. And, last year we talked with, many clients, and there were dozens of billions of dollars that needed to be placed across, call it 40 meetings. And then you talk to many of the same clients, and they're like, yeah, we also though do want to sell a ton of stuff and put that capital back to work somewhere else. And so everybody wants to unlock this thing. And I think the key to it will be fundamentals and not interest rates, because I just don't think we're going to see the interest rates go where we need them to unlock things soon enough.
I completely agree. I'm coming more and more to that same conclusion, that it's about that rent growth rebound that everybody needs to see before, because nobody wants to assume 4 or 5% rent growth. And by the way, you made a really good point about Air Communities and Blackstone. So for those listening, that was, I think, a $10 billion deal out of a little north of $100 billion in sales last year. So that's like almost 10% of the entire transaction markets. That's a great point, Matt. Now you touched on this briefly, but I would like for you to expand this a little bit. As you talk to would-be buyers out there and active buyers, tell us a little more about what they're looking for and what they might want, like in terms of markets, types of deals. Like, what's attractive right now? Is it still just the well-located Class A, or is it you seeing interest in different markets, smaller markets? What's the latest buzz?
It is still core plus. Mostly core plus. It's the high quality stuff that's in relatively supply insulated neighborhoods or markets, submarkets, and so you can find that in Phoenix. Even though Phoenix is a high supply market, you can find those assets, and the sellers know that what they've got, right? And so we are seeing some very deep bid sheets, even in markets that maybe are a little slower for investment activity today than they normally are. What is selling is that high quality, well located. You could almost call it irreplaceable in some instances, where you just can't build around it. And those properties, I mean, we're still seeing low 4 caps in Austin, Texas, with a runway of more than a year, more than 2 years of negative leverage.
Yeah.
Right. And so this does tie back to just the conversation we were just having. I think that what buyers, even in markets like Austin, I think what they're looking at is, look, if they can buy an underperforming asset with 12 weeks of free rent, right, and they can reasonably assume that they can burn off those concessions over the next 12 months, all right, that's almost a 25% bottom line improvement if you can eliminate 3 months of free rent from your
yeah.
Well, exactly. So they're not just looking for the rent growth. They're looking for those more nuanced improvements in the market to see 12 weeks go to 10, go to 8.
Yeah.
Right. Which I know translates to rent
Absolutely.
growth, but they want to see it showing up where they need it to.
Yeah. So speaking of rent growth, CBRE always shares the underwriting expectations from your clients, and every time y'all post this, I know you always get a little bit of grief about those numbers. So I got to ask you, how do you reconcile the projections for average rent growth, low to mid 3% range on a 5-year CAGR, with the underwriting being done by winning bidders, which is 4% plus in many cases?
That's a great question. In fact, it's one that it's a point I made recently back in May at our CBRE Multifamily Summit. And if you haven't attended that, it is an awesome event.
You need to invite me to it.
Oh, we will. We'll get you on stage. Yeah. I think it comes down to sort of understanding what it is we're forecasting, right? Because we do get grief, not just from that underwriting survey, but we'll get grief from our clients, with our brokers, what do you mean you're forecasting, a 3.2% CAGR over the next 5 years in Phoenix? And it's like, well, I actually kind of thought that was bullish, but okay. The reality is, right, we're forecasting new rents, trade outs.
Yeah.
And they're effective, right? Asking rents though. And so what we're not doing, right, is we're not forecasting renewals. All right. And we're not incorporating any sort of property level assumptions around your underperforming property with 12 weeks of free rent and burning that off over the next 12, 18 months. We're just forecasting asking rents on a net effective basis. And today, that's only like 45% of all leasing. So if you're underwriting a property, you're underwriting 55% renewals in some cases, right? And 45% new leases. So if you plug our number in straight away with total agreement, and you plug in a stronger renewal expectation, which today is what we're experiencing, right? We're seeing stronger rent growth. Maybe it's still negative in some of the Sunbelt, but it's less negative. It's barely negative, right? And so if you combine those two, you can reconcile that what it takes, the rent growth it takes to be the winning bidder, compared with what the third parties are forecasting. And this is a challenge in ICs, right? And in investment committees, right? They go back and forth on what they can assume for rent growth and occupancies. And, somebody will point to some third party projection, and it's only part of the story. In fact, it's less than half the story today.
Yeah.
Because renewals are up so much.
Even in the Sunbelt, to your point, that's been, I think, to me, one of the most amazing stories the last couple of years is that supply goes to 40-year highs and retention rates go up. And they're still getting, 3.5%, 4% renewal rent growth in some of these markets. Not Austin, but in a lot of other spots. I mean, it's a remarkable story.
I was on with the Real Estate Alert for a long article they did, and this came up. It's not that they couldn't understand it. It's just that they needed to understand why what you just said is true. How can we be in a generational high supply environment where there's so many options and so many discounts to take advantage of, and yet you're renewing your lease sometimes at a positive rent growth, offer? And I think it's important to introduce behavioral economics, right? And to say moving is a pain in the butt, right? And the cost of moving isn't just the difference in rents that you pay each month. It's organizing movers, begging your friends to borrow their trucks. Like, it's all of it, right? And it's the stress and it's the anxiety. It's coming up with a new security deposit and having to wait for the one that you have already deposited in. It's all these little nuances that make moving such, and again, what did I say? 8 cities in 11 years?
Well,
I know.
And on top of that, I will make the point too that I've told people all the time, I don't think we give property managers enough credit because they have done, there's been so much focus in the industry on, heads in beds, resident satisfaction, new technologies, all of these things to make, especially the AB market, to make residents happier and stickier, to drive renewals, protect occupancy. Like I can't understate the role that the intentional effort to improve that metric gets. If you're really focused on it, you should see some improvement, and we have.
Oh, Jay, and I heard you speak in Denver at ULI, and one of your points was renewals are up, and part of it is because tenants are happy where they are, right? And I'll tell you, Google is powerful. I was moving to Cherry Creek, and I hadn't been there in several years, and I went to Google Maps and I started looking at all I knew I wanted to be in this area. I started looking at all the properties, and then I started looking at all the reviews. And I'll tell you, I ended up at a property where the property manager's name was in every other review, and just how happy they were.
Wow.
And it had a 4.4 star review compared with a 3.8 over here and a 4.1 over there. My decision had almost everything to do, because the prices were all very similar. So it really had everything to do, my decision ultimately, with how happy my neighbors are.
Yeah, that's great. Love to hear that. All right. So, Matt, we've been talking mostly in our conversation about the capital market side about kind of AB assets, newer vintage, well-located, core plus. Let's talk about value add. That's, I'm of the view, I think like a lot of people, not really an original thought here, that I think we've maybe bottomed, already improving on that well-located A, B plus market. I still think we're trying to find the floor for that, true C market, that busted value adds. Still some challenging fundamentals as well, messier rent rolls, CapEx issues. What's your outlook in terms of fundamentals there? And when do buyers and lenders get more comfortable with it again?
Well, the latest stats, I think, show Class C with the strongest rent growth among A, B, and C.
Mm-hmm.
All right. And it's a messy classification methodology of just really stratifying rents based on their, relative to their market. But the lower rent properties are actually performing really well right now. It's Class B that has been hovering around 0% rent growth for like 2 years, 8 quarters. And I think some of it's filtering up and filtering down. And so like renters, choosing to go up and down in quality. And so I think, I think that right now in the value add space, I think there's a lot of upside and a lot of opportunity there. I think that I do think that there is some additional price discovery that's gonna play out here soon. I do wonder to what extent it comes from distress.
Yeah.
All right. We know that in 23 and 2024, a huge amount of the maturities in those years were from debt fund loans, right? And those are short term. And in those debt fund loans, all you had to do was replace your interest rate cap to extend 12 months. Okay. Well, now we're there, right? Or we're past that. And so lenders were working in other ways to extend the rest of the loans another 12 months. This year, earlier in the year, and still today, we're hearing that lenders are really focused on sort of recalibrating their book, right, on a new term basis. So that means that you either need to come in with some fresh capital, or you need to find an alternative lender to take over the loan, or you need to sell it. And so there is some question I have around some of these really distressed, busted Class C properties, as you called it, and whether we start to see a ramp up in for sale activity there. Maybe some of it's forced sales, right? And owners just wanting to redeploy that capital and put it to work to somewhere else, and take whatever hit they need to. I do think there's some price discovery yet ahead of us, and I do think that in some cases, not all, that some of that value add product will experience some cap rate expansion from where I think things are trading today. But I do think it's a chicken and the egg situation, because we also know that it's incredibly difficult to raise equity for value add today, and lenders are shying away from it. So if you've got, if equity and debt starts to loosen up a little, right, then will we see sellers coming to the market before equity and debt, and we see price discovery and cap rate expansion? Do we see equity and debt coming to the market for value add first and deepening those bid sheets, and we see cap rate stability, right? I don't know what the answer to that story really looks like, and whether we're searching for the bottom or maybe we have found it. I think it really, though, depends on those elements. But I do agree that fundamentals seem inevitable, that they are recovering now. As I said, Class C rent growth is some of the strongest in the country, and I think I do think equity and debt will begin to recognize that, and I think they'll clean up some of their rent rolls, as you said, and we'll see that space take off again.
Yeah, I think another challenge is some of those Class C, B minus buyers are sidelined more than the Class A buyers. So we'll see. And Matt, other thing I'll tell you too, I'll get your thought on this real quickly, is that when I talk to, I've heard from some institutional and larger groups, so this like, we're getting back into value add again. I'm like, well, what is value add? And then it's like, it's 1998 early 2000s in high quality suburban areas of Dallas or Nashville or Denver. It's like, okay, well, that's not exactly, I think, what we're talking about here.
It's not, and I agree with you. We attainable housing, workforce housing, lowercase a, affordable, right? Value add, there's all these terms kind of rolling around, and it might be time to start defining these a little more, cleanly.
Speaking of that, if you can do me a favor, if you could tell all your broker colleagues, no more class B/C on broker packets. There's no such thing as a B/C. You're a B or a C, not a B/C. They're very different asset classes.
What they mean, Jay, is class A and everything.
Yeah, right. All right. Well, Matt, this has been fun. Before we go, I know y'all have a big new report. It just came out, the mid-year report. But where could people find that?
Find it on CBRE.com/insights, I believe, and or just Google CBRE mid-year report. You'll mid-year outlook. You'll find it. It's great. It's short. It's broken down by the sectors and our sort of macro and capital markets outlook. We've also got a couple of videos coming out that'll be available on the same landing page. So please check it out.
Definitely check it out. Oh, you guys always put out great content. Well, Matt, thanks so much for spending part of your day with me. Really appreciate it. And thanks so much.
Thanks, Jay. Really appreciate you.
And that's a wrap on episode number 44. Big thanks to Matt for being our guest today. Thank you to JPI, to Waymaker, and to Foxen for your sponsorship. Thank you to all of you for spending part of your day with us. We appreciate it. We'll see you next week.